Welcome to cryptocurrency trading, a dynamic and innovative market. Cryptocurrency trading involves buying and selling digital assets on various exchanges to profit from price fluctuations. Unlike traditional markets, cryptocurrency markets operate 24/7, offering unique opportunities for traders around the globe. Cryptocurrency markets are known for their high volatility, with prices capable of dramatic changes in short timeframes. The crypto landscape presents unique opportunities alongside significant challenges that traders must navigate. This video series will explore effective strategies for navigating the volatile crypto landscape while managing risk and maximizing potential returns. Technical analysis is a trading methodology that involves studying price charts and using indicators to predict future price movements. Price charts form the foundation of technical analysis, showing historical price movements over time. Support and resistance levels are key concepts in technical analysis. Support represents a price level where buying pressure exceeds selling pressure, preventing further decline. Resistance is the opposite, a price level where selling pressure exceeds buying pressure, preventing further rise. These levels often act as barriers to price movement. Prices often bounce off these levels. When price approaches support, buyers step in. When it approaches resistance, sellers become active. Trend lines help identify the overall direction of price movement. An uptrend line connects the lows of a price chart during an upward trend. Conversely, a downtrend line connects the highs during a downward trend. Let's see how price behavior changes in a downtrend. Chart patterns are specific formations that suggest potential future price movements. A head and shoulders pattern is a reversal pattern signaling a potential downtrend. A double bottom pattern is a bullish reversal pattern. It forms when price reaches a low, rebounds, then tests that low again before moving higher. Technical analysis helps traders identify optimal entry and exit points based on historical price data and market psychology. Entry points often occur at support levels after confirmation of trend reversals or following breakouts from chart patterns. Exit points may be determined by reaching resistance levels, price targets derived from patterns, or when technical indicators signal trend exhaustion. Risk management is crucial. Always set stop losses based on technical levels to protect your capital if the trade moves against you. To summarize, technical analysis provides traders with tools to interpret price action and make more informed trading decisions. By studying historical price data and understanding market psychology, you can identify potential market movements before they occur. Fundamental analysis in cryptocurrencies is the process of evaluating a project's underlying value, looking beyond price charts and market trends. Unlike technical analysis, which focuses on price charts and patterns, fundamental analysis examines the intrinsic value of a cryptocurrency project. While technical analysis helps with timing the market, fundamental analysis helps you decide which projects have long-term potential based on their utility and adoption. When conducting fundamental analysis, there are 5 key components you should evaluate to assess a cryptocurrency project's potential. First, examine the team's experience, track record, and transparency. Strong teams often lead successful projects. Next, evaluate the technology. Look for innovation, code quality, and security audits to ensure the project is built on solid foundations. The use case is crucial. Does the project solve a real problem? Is there market need? How does it compare to competitors? Partnerships and ecosystem integrations indicate industry validation and can accelerate adoption. Finally, tokenomics, the economic model of the token, including supply, distribution, utility, and incentive structures. Developing a consistent evaluation framework helps you compare different projects objectively. Rate each component from 1 to 5. Here's an example of a project with strong team and technology scores. The use case and partnerships show promise, but have room for improvement. Tokenomics are well designed, contributing to a strong overall rating. Fundamental analysis offers several practical benefits for cryptocurrency traders and investors. It helps you identify sustainable long-term investments with real utility and adoption potential. You can avoid hype-driven projects that lack solid foundations, reducing your risk of substantial losses. Understanding the fundamentals helps you recognize potential catalysts for future growth before they're reflected in price. Perhaps most importantly, fundamental analysis builds conviction for holding through market volatility as you understand the long-term value proposition. Day trading involves opening and closing positions within a single day to capitalize on short-term price movements. Successful crypto day traders use several key strategies. Let's explore each one. First, scalping involves making numerous small profits on minor price movements. Traders execute many high-frequency trades throughout the day. Momentum trading involves identifying and following strong market trends with the expectation they will continue in the same direction. Breakout trading involves entering positions when the price breaks through established support or resistance levels, signaling a potential new trend. Let's compare these 3-day trading strategies. Each has different time frames, risk levels, and skill requirements. Successful day trading requires discipline, a solid trading plan, and the ability to quickly analyze market conditions. Choose strategies that match your trading style and risk tolerance. Swing trading is a strategy for capturing gains from price swings that occur over periods ranging from days to weeks. Unlike day trading, which focuses on hours, or position trading, which spans months to years, swing trading captures medium-term price movements. Swing traders identify cyclical patterns in price movements, looking for significant swing highs and swing lows to time their entries and exits. These traders buy at swing lows when prices are oversold and sell at swing highs when prices are overbought. The Relative Strength Index, or RSI, is a key indicator for swing traders. It measures the speed and change of price movements, oscillating between 0 and 100. An RSI above 70 indicates overbought conditions, signaling a potential selling opportunity. An RSI below 30 suggests oversold conditions, indicating a possible buying opportunity. The Moving Average Convergence Divergence, or MACD, is another essential indicator. It consists of the MACD line, signal line, and histogram. The histogram represents the difference between the MACD line and signal line. When the MACD crosses above the signal line, it generates a bullish signal. When it crosses below, it indicates a bearish signal. Let's summarize the key points of the swing trading approach. Swing traders look for cyclical patterns in price movements that span days to weeks rather than hours or months. The Relative Strength Index helps identify overbought conditions above 70 and oversold conditions below 30, signaling potential reversal points. MACD crossovers provide crucial entry and exit signals when the MACD line crosses above or below the signal line. Successful swing traders always consider the current market trend and key support and resistance levels when planning their trades. Finally, setting defined stop-loss and take-profit targets for each trade is essential for effective risk management in swing trading. Position trading is a long-term strategy where traders hold cryptocurrency assets for months or even years, rather than days or weeks. Let's compare position trading with other trading timeframes. While day traders focus on hours or days and swing traders look at weeks, position traders think in terms of months or years. Position trading requires a strong foundation in fundamental research. Successful position traders thoroughly analyze projects based on several key factors. Position traders must be prepared to withstand significant market volatility. While short-term price movements can be dramatic, position traders focus on the long-term uptrend of quality projects. Smart position traders use bear markets as accumulation opportunities. By systematically buying during market downturns, they acquire assets at discounted prices before the next bull cycle. Successful position traders share several key characteristics. They exhibit patience through market cycles, conduct thorough research, maintain strong conviction in their investments, control their emotions during volatility, and strategically accumulate during bear markets. Let's look at Bitcoin as an example of position trading in action. A position trader who accumulated during the 2018 bear market around $3,500 and held until the 2021 bull market peak at $65,000 would have achieved a return of over 700%. Position trading in cryptocurrency requires patience and conviction, but for those who can withstand volatility and focus on strong projects, it can yield exceptional long-term returns. Dollar cost averaging, or DCA, is an investment strategy where you invest fixed amounts at regular intervals, regardless of the market price. Rather than trying to time the market, DCA involves making consistent investments, which helps reduce the impact of volatility over time. How DCA works in a volatile market. Here's a simplified price chart showing Bitcoin's price fluctuations over a 12-month period. With traditional lump sum investing, timing becomes critical. Buy at the wrong time, and you could significantly overpay. Comparing dollar cost averaging with lump sum investing. With DCA, you might invest $100 every week, totaling $400 per month. This spreads your risk across different price points. In contrast, lump sum investing means putting all $400 in at once, which can be risky if the market drops shortly after your investment. Here's a practical example of how dollar cost averaging works over 4 weeks. In week 1, Bitcoin is at $60,000. Your $100 investment buys you 0.0017 Bitcoin. In week 2, the price drops to $55,000. Your same $100 investment now buys more Bitcoin, 0.0018. In week 3, the price rises to $65,000, and you buy less Bitcoin with your $100. Finally, in week 4, the price drops to $50,000, allowing you to purchase more Bitcoin with your standard $100 investment. After 4 weeks, your average cost basis is $57,143, which is lower than if you had invested the entire $400 in week 1 at $60,000. Dollar cost averaging offers several important benefits for cryptocurrency investors. Perhaps most importantly, DCA reduces the psychological stress of trying to time market entries perfectly, allowing investors to stick with their investment plan regardless of market conditions. This strategy is particularly effective during bear markets, as it allows you to accumulate assets at progressively lower prices without the emotional challenge of investing a large sum all at once during market decline. Grid trading is a systematic strategy that automates buying at lower prices and selling at higher prices within a predetermined range. This strategy works particularly well in sideways markets, where prices oscillate between support and resistance levels. Traders set up a grid of orders at regular price intervals within a predetermined trading range. As the price moves through different levels, buy and sell orders are automatically executed. Buy orders at lower levels and sell orders at higher levels. Grid trading has several advantages, especially in sideways markets. It capitalizes on price oscillations, automates the buy low and sell high strategy, works well when price ranges within boundaries, and removes emotional decision-making from trading. When setting up a grid trading strategy, there are several key parameters to consider. Grid spacing determines the distance between order levels. The price range sets upper and lower boundaries. Investment per grid defines how much capital goes into each buy order, and the number of grids determines how many trades will be executed. Arbitrage in cryptocurrency trading involves exploiting price differences of the same asset across different exchanges or markets. For example, Bitcoin might be trading at $29,000 on one exchange, while simultaneously trading at $29,200 on another. This $200 difference creates an arbitrage opportunity. Traders can buy Bitcoin on exchange A and immediately sell it on exchange B to capture this price difference as profit. Successful arbitrage trading requires several key components. First, you need quick execution speed. Arbitrage opportunities typically last only seconds or minutes. Second, low transaction fees are essential. high fees can quickly eliminate your profit margin. Third, sufficient capital is needed to make the trades worthwhile after fees. Fourth, you must maintain accounts on multiple exchanges with funds ready to trade. Finally, specialized software or trading bots help identify and execute arbitrage opportunities faster than manual trading. There are multiple types of arbitrage strategies in cryptocurrency markets. In triangular arbitrage, traders execute a series of trades between three different cryptocurrencies to exploit price inconsistencies. For example, you might start with Bitcoin, trade it for Ethereum, convert Ethereum to USDT, and then convert USDT back to Bitcoin. If market inefficiencies exist, you'll end up with more Bitcoin than you started with. Despite its potential, arbitrage trading comes with several challenges and risks. To summarize, arbitrage trading in cryptocurrency markets offers profit potential by exploiting temporary price differences across exchanges or trading pairs. Success in arbitrage requires speed, low transaction costs, sufficient capital, and ideally automated systems to identify and execute trades quickly. Leverage and margin trading are powerful tools that allow traders to control larger positions with less capital. When you trade with leverage, you're essentially borrowing funds to increase your position size. For example, with 1 Bitcoin and 5x leverage, you can control a position worth 5 Bitcoin. The key concept to understand is that leverage amplifies both profits and losses. Let's see how price movements affect leveraged positions. In a bullish scenario where prices rise, leverage multiplies your gains. However, in a bearish scenario, leverage also multiplies your losses by the same factor. Let's look at specific examples. With a 10% price increase, 5x leverage gives you a 50% profit, while 10x leverage yields a 100% profit. But the same principle applies to losses. A 10% price decrease results in a 50% loss with 5x leverage, and with 10x leverage, you could lose your entire investment from just a 10% price drop. This brings us to liquidation risk. When trading with leverage, your position will be forcibly closed if the market moves against you by a certain percentage. Because of these risks, proper risk management is crucial when using leverage. Here are some essential tips to protect your capital. Remember, while leverage can significantly increase your profits, it also dramatically increases your risk. Always approach leverage trading with caution and a clear strategy. Effective risk management is essential for long-term success in cryptocurrency trading. The first crucial technique is position sizing. Never risk more than 1 to 2% of your total capital on a single trade. Stop-loss orders are your safety net. They automatically close positions when the market moves against you, limiting your potential losses. Diversification spreads your risk across different assets. This reduces your portfolio's overall volatility and protects against single asset crashes. Maintaining a reserve of stable assets is crucial for surviving market downturns. Keep 20 to 30% of your portfolio in stablecoins or fiat currency. Let's summarize the key risk management techniques that every crypto trader should implement. Trading psychology represents the emotional and mental state of a trader. It plays a crucial role in determining success in cryptocurrency markets. Traders face 3 common psychological challenges. FOMO, or fear of missing out, causes impulsive buying at market peaks. Panic selling occurs during market downturns, often right before a recovery begins. Overconfidence develops after successful trades, leading to excessive risk-taking and eventual losses. Developing emotional discipline is key to overcoming psychological challenges. Start by keeping a detailed trading journal. Establish clear, predefined trading rules to remove emotional decision-making from your process. Most importantly, stick to your strategy even when emotions try to pull you in different directions. Let's see a practical example of how trading psychology affects market decisions. This chart shows both emotional and disciplined approaches. The FOMO zone is where traders often buy at market peaks due to fear of missing gains. The panic zone shows where emotional traders sell at lows. In contrast, Disciplined traders make calculated entries at support levels and take profits according to their predetermined strategy. Remember these key takeaways to master trading psychology. Awareness of your emotions is just the beginning of the journey. Trading indicators are mathematical calculations that help traders identify potential entry and exit points in the cryptocurrency market. They analyze price action and volume data to help predict future market behavior. Let's explore some of the most popular indicators. Moving averages help identify trends by smoothing out price data over a specified period. A 20-period moving average smooths out price fluctuations, making it easier to see the overall trend direction. The Relative Strength Index, or RSI, helps traders identify overbought or oversold conditions. Values above 70 suggest overbought conditions, while values below 30 suggest oversold conditions. The MACD, or Moving Average Convergence Divergence, identifies momentum shifts. When the MACD line crosses above the signal line, it suggests bullish momentum, while a cross below indicates bearish momentum. Bollinger Bands measure market volatility. They consist of a middle band, which is typically a 20-period moving average, and two outer bands that are two standard deviations away from the middle. Remember, combining multiple indicators often provides more reliable signals than using just one. This approach helps confirm trends and reduces false signals. Chart pattern recognition is an essential skill for cryptocurrency traders. These patterns help predict potential price movements by analyzing historical price data. Chart patterns fall into two main categories: reversal patterns that signal a change in trend direction, and continuation patterns that indicate a pause in the current trend. The head and shoulders pattern is a reversal pattern that typically forms after an uptrend. It consists of three peaks, with the middle peak, the head, being higher than the two surrounding peaks, the shoulders. The pattern has three key components: the left shoulder, the head, and the right shoulder. The neckline connects the lows between these peaks. When the price breaks below the neckline after forming the right shoulder, it signals a potential downward move. Traders often target a price decline equal to the distance from the head to the neckline. Double tops and double bottoms are strong reversal patterns that occur when the price tests the same level twice but fails to break through. A double top forms when the price reaches a high point twice but fails to break higher. This creates two peaks at roughly the same price level. The area between the peaks forms a support level. When the price breaks below this support after the second peak, it confirms the double top pattern and signals a potential downward move. Conversely, a double bottom pattern signals a potential bullish reversal after a downtrend. The double bottom creates two troughs at similar price levels. The area between forms a resistance level. When price breaks above this resistance after the second trough, it confirms the pattern and signals a potential upward move. Triangle patterns represent periods of consolidation where the price range narrows over time. There are three main types: ascending, descending, and symmetrical triangles. An ascending triangle forms with a flat resistance line at the top and an upward sloping support line at the bottom. This pattern is typically bullish, indicating buying pressure is building. When the price breaks above the resistance line, it confirms the pattern and often leads to a strong upward movement. The price target is typically the height of the triangle added to the breakout point. A descending triangle has a flat support line at the bottom and a downward sloping resistance line at the top. This pattern is typically bearish, suggesting selling pressure is increasing. When the price breaks below the support line, it confirms the pattern and often leads to a downward movement. The projected target is typically the height of the triangle subtracted from the breakdown point. Flags and pennants are continuation patterns that represent brief pauses in a strong trending market. They typically form after a sharp price movement, known as the flagpole. A bullish flag pattern starts with a strong upward move, forming the flagpole. This is followed by a consolidation period where the price moves in a channel that slopes against the prevailing trend. When the price breaks out of the flag pattern in the direction of the original trend, it confirms the continuation pattern. The projected target is typically the length of the flagpole added to the breakout point. A pennant is similar to a flag, but forms a small symmetrical triangle. It also begins with a strong move, the flagpole, followed by a brief consolidation period where buyers and sellers reach temporary equilibrium. The breakout from a pennant typically occurs in the direction of the flagpole. Like the flag pattern, the measured move for a pennant is often the length of the flagpole applied from the breakout point. Chart patterns aren't just random shapes. They reflect the psychology of market participants. Reversal patterns like head and shoulders or double tops show shifts in market sentiment, while continuation patterns like flags and pennants represent brief pauses in a trend. Support and resistance areas indicate psychological price barriers where buying or selling pressure intensifies. When a pattern breaks out, it often signals that market participants have reached a consensus about the next price direction. To effectively use chart patterns in your cryptocurrency trading, remember these key points. Patterns help predict potential price movements, but always confirm with other indicators. Volume often increases at pattern completion, strengthening the signal. And different timeframes may show different patterns, so analyze multiple timeframes for context. Trading bots are automated programs that execute cryptocurrency trades based on predefined rules and parameters without human intervention. Trading bots offer three key advantages over manual trading. First, they can operate 24/7, never missing opportunities in a market that never sleeps. Second, bots eliminate emotional decision-making, avoiding common pitfalls like fear and greed that affect human traders. Finally, bots execute trades at lightning speed, completing transactions in milliseconds, much faster than any human. Let's examine three popular trading bot strategies. First is market making, where bots place buy and sell orders near the current market price. Next is trend following, where bots analyze market momentum to identify and follow emerging trends, entering and exiting positions at optimal points. Finally, arbitrage bots exploit price differences of the same asset across multiple exchanges, buying low on one exchange and selling high on another. While trading bots offer many advantages, they also have important limitations. First, they require careful configuration. Incorrect parameters can lead to substantial losses. Second, despite being automated, bots are not set-and-forget solutions. They require regular monitoring and maintenance to ensure optimal performance. Finally, bots may perform poorly during unexpected market conditions or extreme volatility, as they can only follow their programmed logic. For optimal results with trading bots, follow these best practices. Start with small amounts until your bot proves itself. Always backtest your strategies before live deployment. Implement safety measures like stop losses to limit potential losses, and stay informed about market conditions that might require adjustments to your bot. On-chain analysis examines data directly from blockchain networks to inform trading decisions. Blockchain networks provide transparent, immutable data that analysts can extract to gain trading insights. Let's explore the key metrics used in on-chain analysis. Active addresses measure network usage by counting unique addresses transacting on the blockchain. Transaction volume shows the amount of cryptocurrency being transferred, indicating market activity. Miner behavior provides insights into whether miners are accumulating or distributing their rewards. Whale movements track large holders whose actions often precede significant price movements. On-chain data often shows correlations with price movements, with metrics frequently serving as leading indicators. Here we can see how active addresses in gold often increase before price movements in green, providing early signals to traders. Now, let's look at how traders can apply on-chain analysis in practical trading scenarios. By monitoring whale addresses, traders can identify accumulation phases that often precede significant price increases. Network growth, measured by increasing active addresses, frequently signals the early stages of bull markets. Miner capitulation, when miners sell their holdings en masse, often marks market bottoms and potential buying opportunities. Tracking the flow of funds to and from exchanges helps predict imminent selling or buying pressure in the market. On-chain analysis gives crypto traders a unique advantage, insights directly from blockchain data that are simply not available in traditional markets. Cryptocurrency markets move through predictable cycles that repeat over time, though with varying duration and amplitude. Understanding crypto market cycles is crucial for successful trading. These cycles consist of four distinct phases: accumulation, markup or bull market, distribution, and markdown or bear market. The accumulation phase occurs after a bear market when prices have bottomed out. During this period, the market consolidates within a range, volume is low, and sentiment is generally negative. However, this is when smart money begins quietly accumulating assets at discount prices. During the accumulation phase, effective strategies include dollar cost averaging, accumulating quality projects with strong fundamentals, and conducting thorough research. This phase offers the best risk-reward ratio for long-term investors. The markup phase, or bull market, begins when prices break upward from their accumulation range. Volume increases significantly as more market participants enter. Media coverage turns positive, attracting retail investors. This phase is characterized by rapidly increasing prices and growing optimism. During the bull market, effective strategies include riding momentum with proper stop losses to manage risk, taking partial profits as prices rise, and watching for sector rotations as different crypto assets take turns leading the market. The distribution phase appears at market tops when euphoria is at its peak. Price action becomes more volatile, with large swings often forming a topping pattern. Smart money begins selling their accumulated positions to eager retail buyers, and lower highs start forming despite continuing optimism. During the distribution phase, wise traders take significant profits, tighten their stop losses to protect gains, and gradually reduce their overall market exposure. This is when risk management becomes crucial to preserve the profits made during the bull market. The markdown phase, or bear market, is characterized by consistently falling prices, decreasing trading volume, and overwhelmingly negative sentiment. During this phase, we often see capitulation events where even strong believers sell their holdings due to fear and financial pressure, creating market bottoms. During bear markets, the most effective strategy is often capital preservation. Staying primarily in cash or stablecoins helps avoid catching falling knives. This is also the time to research for the next cycle's opportunities and watch for signs that the market may be bottoming. Successful traders adapt their strategies to the current market cycle. Let's review the most effective approaches for each phase. Identifying transitions between market cycles is challenging but crucial. Look for trend exhaustion signs, monitor volume patterns, track sentiment changes, and analyze on-chain metrics to recognize when the market is shifting from one phase to another. By understanding where we are in the crypto market cycle, we can optimize our trading strategies and manage risk more effectively. Let's examine the key differences between trading altcoins and Bitcoin. Bitcoin offers moderate returns with lower risk as the market leader. Altcoins provide higher potential returns, but with significantly increased volatility and risk. There are three primary strategies traders use when approaching the altcoin market. First, trading altcoins against Bitcoin pairs can help increase your Bitcoin holdings over time. Second, focusing on sector rotations lets you capitalize on trending niches like DeFi, NFTs, or Layer 1 blockchains. Third, identifying promising projects before mainstream adoption can lead to substantial returns. Understanding Bitcoin dominance is crucial for timing your altcoin trades. Bitcoin dominance measures Bitcoin's market cap as a percentage of the total crypto market. When Bitcoin dominance falls, capital typically flows into altcoins, creating altcoin seasons where altcoins outperform Bitcoin. Conversely, when dominance rises, Bitcoin usually outperforms altcoins. Timing your altcoin trades can significantly impact profitability. Let's look at when to buy and sell altcoins. Consider buying altcoins when Bitcoin dominance is falling and Bitcoin price stabilizes, signaling potential capital rotation into alts. Conversely, consider selling altcoins when Bitcoin dominance begins rising and Bitcoin shows strength. Let's review the key takeaways for trading altcoins versus Bitcoin. Remember that higher risk requires strategic position sizing. Always trade with the trend in Bitcoin dominance and consider taking profits back to Bitcoin during strong altcoin markets. Finally, always research fundamentals before trading new altcoins. By understanding these dynamics between Bitcoin and altcoins, you can develop more effective strategies for navigating the cryptocurrency markets. Security is paramount in crypto trading. Without proper security measures, your assets are at significant risk. Let's examine 5 critical security practices every crypto trader must implement. Hardware wallets are physical devices that store your private keys offline, making them immune to online attacks. They're essential for long-term storage of significant crypto holdings. Two-factor authentication adds a crucial second layer of security to your exchange accounts. Even if your password is compromised, attackers still can't access your account without the second factor. Using strong, unique passwords for each platform is essential. Avoid common patterns and consider using a password manager to securely store complex credentials. Be vigilant against phishing attempts. Attackers create convincing fake websites and emails to steal your credentials and private keys. Always verify URLs carefully and be suspicious of urgency tactics. Your private keys are the absolute keys to your crypto kingdom. Never share them with anyone under any circumstances. Once compromised, your funds can be stolen instantly and irreversibly. Unlike traditional finance, crypto has no chargeback mechanisms. If your funds are stolen due to a security breach, they're likely gone forever, with little to no recourse. Implementing proper security isn't optional, it's essential. Building a structured trading plan is fundamental to success in cryptocurrency trading. A comprehensive trading plan serves as your personal trading constitution and contains several essential components. Let's break down what should be included in your trading plan. Review process, regular plan evaluation, performance review schedule, adjustment criteria, journal trading observations. Let's walk through a position sizing example. With a $10,000 account risking 2% per trade, your risk amount is $200. If Bitcoin is trading at $50,000 with a stop loss at $48,500, that's a $1,500 price difference per Bitcoin. Dividing your $200 risk by the $1,500 per coin difference gives you a position size of 0.04 Bitcoin. This ensures you only risk your predetermined 2% of capital. Your trading plan should define specific entry and exit rules. Let's look at an example. For entries, you might specify criteria like breakouts above resistance, volume increases of at least 50%, and RSI readings above 50. Exit rules are equally important, defining take-profit levels, stop-loss placement, and trailing stop parameters. Together, these rules eliminate emotions from your trading decisions. Finally, your trading plan should include a regular review process to evaluate performance and make improvements. Track key metrics like win rate, profit factor, average win-to-loss ratio, maximum drawdown, and expectancy. Regularly review these metrics against your goals. Based on performance data, identify specific improvement actions to refine your strategy and enhance results. This continuous improvement cycle is essential for long-term success. To summarize, a comprehensive trading plan eliminates emotional decision-making and provides a framework for consistent execution. Document all aspects of your trading approach, from strategies to risk parameters. Follow your plan consistently, especially during periods of high volatility. And remember to regularly review your performance and refine your approach for continuous improvement. Backtesting is the process of testing trading strategies against historical market data to evaluate performance before risking real capital. This simulation allows traders to see how their strategies would have performed in past market conditions, providing insights into potential profitability and risk. The backtesting process follows 4 key steps. First, you collect historical market data for the assets you intend to trade. Second, you formulate a trading strategy with clear rules for entries, exits, and risk management. Third, you run performance testing by applying your strategy rules to the historical data. Finally, you analyze the results and optimize your strategy's parameters to improve performance. This process creates a continuous loop of testing, analysis, and refinement. When evaluating backtesting results, several key metrics help assess strategy performance. Win rate measures the percentage of profitable trades. A higher win rate doesn't always mean a better strategy, as the size of wins and losses also matters. Profit factor divides total profits by total losses. Values above 1.5 generally indicate a robust strategy. Maximum drawdown shows the largest decline from peak to trough. This metric reveals how much capital you need to withstand losing periods. The Sharpe ratio measures risk-adjusted returns. It helps compare strategies by accounting for both profitability and volatility. Despite its value, backtesting has important limitations that traders must understand. Most critically, past performance does not guarantee future results. Markets evolve over time, with different regimes and conditions. Historical data may contain inaccuracies, and backtests can't perfectly account for real-world execution issues like slippage. Perhaps the biggest danger is overfitting, optimizing a strategy to perform well on historical data, but failing in live trading. To get the most from backtesting, follow these best practices. Use sufficient historical data covering multiple market cycles, including both bull and bear markets. Include realistic transaction costs and slippage to avoid overestimating strategy performance. Test your strategy across different market conditions to ensure robustness. Employ walk-forward testing to reduce the risk of overfitting. Finally, compare your strategy against benchmark strategies like buy and hold to ensure it truly adds value. In walk-forward testing, you optimize strategy parameters on one segment of data, then validate on an unseen segment before moving forward through time. To summarize, backtesting allows traders to test strategy performance using historical data. It helps identify strengths and weaknesses before risking real capital. Effective backtesting requires careful attention to performance metrics and an understanding of its limitations. It should be part of a comprehensive strategy development process, alongside forward testing and continuous refinement. Remember that backtesting is a valuable tool, but not a guarantee of future performance. The cryptocurrency market evolves at a pace unmatched by traditional markets. What worked in 2017 likely won't work in 2023. Traders must continuously learn and adapt their strategies. Successful crypto trading requires staying informed about three critical areas. First, technological developments. Blockchain protocols constantly evolve with upgrades, new chains, and smart contract innovations. Second, regulatory changes. Traders must monitor evolving global policies and compliance requirements that can significantly impact markets. Third, emerging trends. This includes sector rotations, narrative shifts, and changing market sentiment that drive capital flows. Effective trading requires a continuous cycle of strategy refinement. This cycle begins with executing your strategy and tracking results. You then analyze performance to identify weaknesses, research potential solutions, refine your approach, and begin again with the improved strategy. This ongoing process ensures your trading methods evolve with the market. Mindset plays a crucial role in a trader's ability to adapt. Let's compare fixed and growth mindsets. Traders with a fixed mindset avoid challenges, give up easily, and ignore valuable feedback. They feel threatened by others' success and often blame market conditions for their failures. In contrast, those with a growth mindset embrace challenges, persist through setbacks, and actively learn from feedback. They draw inspiration from successful traders and adapt to changing market conditions. Cultivating a growth mindset is essential for thriving in crypto's highly dynamic environment. Let's conclude with 5 key principles for continuous adaptation in crypto trading. First, dedicate specific time for learning. Successful traders schedule regular research and skill development sessions. Second, consult diverse information sources. This helps form a balanced perspective and avoid echo chambers. Third, test new strategies incrementally. Implement changes with limited capital before full adoption. Fourth, engage with trading communities. Collaboration accelerates learning through shared experiences. Finally, maintain a detailed trading journal. Document your decisions, outcomes, and lessons to identify patterns over time. Remember, in the constantly evolving world of cryptocurrency, the most successful traders are those who never stop learning.